If you hold silver, there's something you need to understand. Something shifted in the silver market this week, and it didn't announce itself with a dramatic price spike, a collapsing chart, or a viral headline. There was no obvious moment you could point to and say, that's it. Instead, the change appeared where stress almost always shows up first, not in price, but in the plumbing of the market itself. Margin requirements quietly adjusted. Delivery behavior in parts of Asia began to act differently. Settlement assumptions subtly tightened. Nothing broke. Nothing failed. But enough changed that analysts who focus on market structure rather than surface-level price action paused and took notice. That distinction matters. In most markets, price is the last thing to react. Long before prices move, pressure builds in less visible places. Higher margins, delayed deliveries, widening regional spreads, and a growing reluctance among counterparties to accept risk on the same terms they did before. This week, silver checked several of those boxes at once. Not loudly, not dramatically. Just enough to raise uncomfortable questions for those paying attention. Public exchange data shows margin adjustments tied to silver contracts rising more than recent volatility would normally justify. One figure circulating among traders suggested an effective margin requirement equivalent to over $300 per contract in certain contexts. On its own, that number doesn't sound alarming. What makes it interesting is the timing. Recent realized volatility in silver has cooled. Under normal conditions, margin follows volatility. This time, margin appears to be leading it. That tells you something about mindset. Clearinghouses are not reacting to what silver did yesterday. They are preparing for what it could do under stress. This isn't a prediction, it's a posture. Risk managers don't wait for confirmation or headlines. They adjust quietly and early. Layer that onto what's been happening in physical markets across Asia. For months now, premiums for physical silver delivery in parts of the region have remained elevated relative to Western benchmarks. Not exploding, not spiraling out of control, but stubbornly persistent. Under normal conditions, arbitrage closes those gaps quickly. Metal moves. Paper settles the rest. When premiums refuse to normalize, it signals friction, logistics constraints, higher financing costs, or limited availability. Often, it's some combination of all three. Reports from refiners and distributors point to longer lead times for certain bar formats, particularly those preferred by industrial users rather than retail investors. That distinction matters. Industrial demand doesn't chase sentiment or headlines. It responds to production schedules, contractual obligations, and substitution limits. When industrial buyers accept higher premiums instead of delaying purchases, it tells you flexibility is limited. At the same time, global silver inventories across major exchanges remain historically tight relative to annual demand. Not empty, not exhausted, just thin enough that small disruptions matter more than they used to. Annual silver demand sits just over 1 billion ounces when you combine industrial use, investment, and jewelry. In recent years, mine supply plus recycling has struggled to consistently meet that level. The gap hasn't triggered a crisis, but it has reduced the margin for error. This is where the conversation becomes uncomfortable for large institutions. Silver is a hybrid market. It trades like a financial asset, but it behaves like an industrial input. That dual nature works smoothly till it doesn't. When financial leverage collides with physical delivery constraints, the adjustment doesn't always show up as a price spike. Sometimes it shows up as tighter terms, higher margins, stricter collateral rules, and more conservative settlement assumptions. Public filings show that bullion banks maintain significant short exposure to silver, largely as part of market making and hedging operations. The gross numbers can look enormous, sometimes cited in the billions of ounces, but net exposure is more nuanced once offsets and client positions are considered. Still, even a fraction of that exposure depends on confidence. Confidence that liquidity will remain available. Confidence that delivery mechanisms will function smoothly. Confidence that settlement assumptions won't be challenged. When that confidence weakens, even slightly, risk managers respond. They don't wait for a crisis. They don't wait for confirmation. They adjust requirements. They demand more margin. They shorten timelines. That S, where the current discussion around a tightening margin environment comes from, not a single dramatic margin call, but a gradual shift that forces participants to hold more capital against the same positions. One possible outcome, if these conditions persist, is reduced willingness to intermediate large silver flows at narrow spreads. That doesn't mean prices explode overnight. It means liquidity becomes more selective. Volatility can compress right before it doesn't. Markets often feel calm just before structural constraints assert themselves. Now consider Asia's delivery dynamics without drifting into rumor. Over the past year, there have been publicly acknowledged disruptions in commodity logistics across the region. Shipping constraints, energy costs, rerouting, and shifting trade relationships. Silver doesn't exist outside that system. When delivery schedules slip, even by weeks, the financing cost of metal rises. Someone has to carry it. Someone has to fund it. Those costs eventually surface in premiums and margin requirements. What makes this more interesting is the macro backdrop. Real interest rates remain positive in many developed economies, which in theory should pressure non-yielding assets like silver. And yet, physical demand hasn't collapsed. In some segments, it's strengthened. That contradiction is worth paying attention to. Central banks aren't accumulating silver the way they accumulate gold, but industrial policy is quietly influencing silver demand. Solar energy, electronics, grid upgrades, and electrification initiatives are all silver intensive. Industry demand forecasts continue to show growth, even if the pace fluctuates year to year. Supply growth, meanwhile, remains constrained by declining ore grades and limited new project development. So you have a market sending mixed signals. Financial indicators say caution. Physical indicators say stay available. Structural indicators say don't assume smooth settlement. None of those signals alone is alarming. Together, they create tension. Here's the part that often gets overlooked. Large institutions don't fear price moves nearly as much as they fear disorder. A fast rally can be hedged, a slow grind can be managed, but a temporary breakdown in delivery assumptions forces behavior changes that ripple outward. Margin requirements are one of the first tools used to preempt that risk. Does this mean there's a multi-billion ounce problem hiding in the shadows? That number gets thrown around because it's dramatic, but it often conflates gross positioning with net risk. Still, even after discounting it, the scale highlights how dependent the system is on confidence that metal can be sourced, contracts rolled, and settlements handled routinely. When confidence wobbles, the response isn't an announcement, it's a quiet recalibration. Higher margins here, tighter terms there, less appetite to warehouse risk. None of this guarantees an outcome, but it changes the landscape in which outcomes occur. What's notable is that none of this requires a crisis to matter. Markets don't need to break to behave differently. They just need incentives to shift. And right now, incentives are shifting slowly, unevenly, and mostly out of sight. So the real question isn't whether silver is about to explode or whether the system is about to fail. Those are the wrong questions. The better question is what happens when a market that relies on flexibility begins to lose it at the margins? How do participants adapt? Who absorbs the cost? And where does the pressure surface next, in price, availability, or structure? When you zoom out, there's a familiar pattern that rarely gets discussed outside institutional circles. These adjustments don't move in straight lines. They move in phases. First comes a subtle repricing of risk, then a behavioral shift. Only much later does price respond, if it does at all. Right now, silver appears to be somewhere between the first and second phase. Nothing looks broken. But a lot feels less comfortable than it did a year ago. One of the less obvious indicators is the behavior of forward contracts. In a healthy market, forward silver contracts trade with predictable carry costs based on interest rates, storage, and insurance. Lately, those costs have behaved inconsistently across regions, not universally higher, but uneven. Some maturities price as if availability is assumed. Others price as if delivery is conditional. That's a polite way of saying counterparties are thinking harder about worst-case scenarios. It doesn't imply an outright shortage. It suggests a mismatch in timing. Silver exists, but not always where it's needed, when it's needed, in the form it's needed. That distinction matters because financial markets are built on assumptions of fungibility and immediacy. When those assumptions weaken, leverage becomes more expensive to maintain. That's where margin pressure quietly does its work. Higher margins don't force anyone out overnight. They simply make it more costly to stay in. For large players running thin spreads at high volume, that matters. Capital tied up in margin is capital not deployed elsewhere. Over time, positions get trimmed, not because anyone is wrong, but because the return on complexity declines. Industrial users operate under a different calculus. They care less about futures curves and more about continuity of supply. A manufacturer doesn't care if silver is up or down a few percent this month. They care whether it shows up on time. If there's even a small risk, it won't. Procurement behavior changes. Maybe inventories rise slightly. Maybe contracts get locked in earlier or for longer durations. Each decision is rational on its own. Collectively, they reduce float, and float is the most underappreciated variable in this entire discussion. Reported inventories tell you how much silver exists. Float tells you how much is actually available to move. When more metal gets spoken for, even without leaving a warehouse, effective liquidity shrinks. Add geopolitics, not as a headline shock, but as background noise. Trade relationships across Asia are being recalibrated. Energy security concerns are reshaping industrial priorities. Supply chains are being redesigned to favor resilience over efficiency. All of that quietly increases demand for critical inputs, and silver sits squarely on that list. At the same time, monetary policy remains in an awkward stalemate. Central banks talk tough on inflation, but debt dynamics limit how restrictive policy can remain for long. Nominal rates are high enough to pressure metals, but long-term confidence in fiat stability isn't exactly strong either. Silver tends to struggle in this environment until something breaks the symmetry. And when it does, the adjustment rarely starts with a headline. It starts with the mechanics. What ultimately disrupts a market like silver isn't always a dramatic price spike. More often, it's something far less visible: a regulatory adjustment, a change in clearing rules, higher capital requirements, tighter reporting standards. None of these developments generate headlines for retail investors, yet each one materially alters how large positions are managed. If holding a short position in silver suddenly requires more capital while offering less flexibility, behavior adapts, not overnight, not publicly, but steadily. This is how markets evolve under pressure, not through spectacle, but through constraint. It's also important to recognize how narratives tend to lag reality. By the time a story becomes widely discussed, it's usually already reflected in price. Right now, silver lacks a dominant narrative entirely. It's not being marketed as an inflation hedge the way gold is. It's not being aggressively promoted as a green metal in mainstream coverage. It isn't the center of speculative attention. It's simply there, quietly absorbing contradictory forces. That quiet can be misleading. Historically, silver doesn't resolve contradictions smoothly. It compresses, it frustrates, and then it moves in ways that surprise both optimists and skeptics. Not because of conspiracy or cartoonish manipulation, but because silver sits at the intersection of too many systems at once: financial, industrial, monetary, and geopolitical. Consider the scale involved. Annual mine supply is roughly 800 million ounces. Recycling can add a few hundred million more in favorable years. Demand fluctuates, but it doesn't collapse easily because so much of it is embedded in production processes rather than discretionary spending. Even small percentage changes matter. A 5% shift represents roughly 50 million ounces. In a market where deliverable inventories are only a fraction of annual flow, that is not trivial. Now place that reality against a financial system where paper claims routinely exceed physical turnover. This isn't unusual. Futures markets are built on leverage. The real question is how comfortable participants are with that leverage. When comfort declines, even modestly, the system seeks equilibrium through higher costs and lower velocity. That's where the Asia delivery dynamic becomes more than a regional issue. Asia isn't just a consumer of silver, it's a central hub for refining, fabrication, and redistribution. Disruptions there don't stay local. Western markets can appear stable while stress accumulates elsewhere, only to surface later through arbitrage gaps, settlement friction, or unexpected pricing behavior. None of this implies inevitability. Markets are adaptive. When margins rise, some participants step back while others step in. When premiums persist, supply eventually responds. But adaptation takes time, and time is where uncertainty lives. Uncertainty is uncomfortable for markets built on precision. Models prefer clean inputs. They don't like variables that refuse to settle. Right now, silver is full of those variables. Demand that doesn't soften easily. Supply that can't accelerate quickly. Financial structures that assume smooth delivery in a world that is becoming less smooth. What makes this especially interesting is how little attention it's receiving. Volatility elsewhere, equities, currencies, geopolitics, is stealing the spotlight. Silver sits in the background, adjusting quietly. Historically, that's often where the most consequential shifts begin. The real story isn't about a single institution, a single margin figure, or a single delivery issue. It's about whether the system continues to absorb stress gracefully, or whether those stresses begin to interact in unexpected ways. Interaction is where complexity appears, and complexity is where models fail. The next layer to watch isn't price, at least not yet, it's behavior. How contracts are structured, how far out deliveries are being booked, how willing counterparties are to roll exposure forward. These are quiet signals, but they're revealing. When tracked together, they suggest a picture that is still forming. To understand where this could lead, you have to stop thinking like a trader watching a screen and start thinking like a risk committee, sitting in a quiet room asking uncomfortable questions. Not what do we think silver is worth, but what assumptions are we making that could be wrong at the same time? That's usually where inflection points begin, long before price reflects them. One assumption embedded in modern silver markets is that paper and physical remain loosely interchangeable. Futures settle. Contracts roll. Delivery is an option, not an expectation. That framework works when trust is high and logistics are smooth. But if even a small percentage of participants begin treating delivery as more than theoretical, the math changes. Not catastrophically, just enough to matter. Imagine industrial buyers already facing longer lead times deciding to secure supply further out than usual. No panic buying, no headlines, just extending coverage from 3 months to 6. That alone reduces spot availability. Now imagine refiners responding by holding slightly more working inventory because shipping schedules feel less predictable. Again, rational behavior, still not dramatic. Taken together, these decisions shrink the effective pool of available silver, even if reported inventories remain unchanged. At the same time, financial participants operating with leverage are being asked to post more margin against positions that haven't moved much in price. That creates a psychological shift. Capital efficiency comes into question. Some positions are trimmed. Liquidity thins slightly, spreads widen marginally. None of this looks like a crisis. It looks like friction. Friction is dangerous precisely because it's subtle. Markets are very good at absorbing shocks. They're less good at dealing with persistent drag. Over time, drag alters behavior. Participants become more selective. Risk tolerance narrows. The system continues to function, but it loses elasticity. Add currency dynamics to the mix. A significant portion of global silver trade is denominated in US dollars, while end users operate in local currencies. When currency volatility rises, hedging costs increase. For some buyers, that makes holding inventory more attractive than relying on just-in-time delivery. Again, not a bet on price, but a hedge against uncertainty. Each of these micro decisions removes a little more metal from circulation. This is where discussions about large short exposure often become misunderstood. It's not about whether shorts exist, they always do. It's about whether maintaining those positions remains efficient. Short strategies rely on the ability to source metal if needed, or at least roll exposure indefinitely. If rolling becomes more expensive or less predictable, the strategy doesn't collapse, it degrades. Institutions don't need to be forced out of positions to change behavior. They just need the risk-reward profile to shift slightly. A few basis points here, a few operational complications there. Suddenly, a position that made sense last year is quietly reduced this year. That reduction doesn't announce itself, it whispers. Another layer worth considering is regulatory optics. Post-crisis financial systems are highly sensitive to anything that looks like concentrated risk. Even well-hedged positions can invite scrutiny if they appear unbalanced. Clearinghouses and regulators don't wait for failures. They preempt them. Margin hikes are one of the cleanest tools available. Technical, neutral, and defensible. From the outside, it looks like nothing is happening. From the inside, capital allocation decisions are being revisited. And when multiple institutions revisit similar decisions at the same time, patterns emerge. Historically, silver has a habit of revealing those patterns late. It doesn't lead macro narratives. It reacts to their intersections. In past cycles, the most consequential moves didn't begin with bullish headlines. They began with frustration, sideways price action, conflicting signals, and analysts talking past each other. That phase is often mistaken for irrelevance. In reality, it's often the prelude. It's important to be clear about what this is not. This is not a call for imminent fireworks. Markets can remain in this kind of limbo longer than most expect. Structural tension doesn't demand immediate release. It simply increases sensitivity. When a catalyst eventually appears, the response can be disproportionate. That catalyst doesn't need to be dramatic. It could be a shipping disruption, a regulatory clarification, a shift in industrial procurement strategy. It could even be the absence of expected supply growth. Sometimes, nothing happening is the thing that forces reassessment. What makes silver particularly interesting in this context is how poorly it fits into simple narratives. It's too industrial to be purely monetary, and too monetary to be just another commodity. That ambiguity keeps positioning fragmented. Fragmentation keeps markets stable until it doesn't. Retail attention tends to chase momentum. Institutional attention watches structure. Right now, structure is doing more than price. That divergence doesn't last forever. Eventually, one catches up with the other. Which one moves depends on how the underlying tensions resolve. If conditions normalize, logistics ease, margins stabilize, inventories rebuild, much of this fades quietly, no drama, no story. But if normalization doesn't arrive on schedule, expectations adjust. And expectations shape behavior long before they shape charts. The reason this matters now, and not years ago, is context. Global systems are less redundant than they once were. Efficiency has been optimized at the expense of slack. That's true in energy, shipping, manufacturing, and finance. Silver sits downstream of all of it. It absorbs the effects without being the cause. So when extreme numbers circulate, billions of ounces, emergency margins, delivery failures, it's tempting to focus on the most dramatic interpretation. But the more accurate story is quieter and more complex. It's a market adjusting to a world that is less predictable than the models assumed. And here's the hardest part to accept. This adjustment doesn't have to end in a single outcome. There are multiple paths forward. Some are boring, some are volatile, some look like nothing, until suddenly they don't. What seems unlikely is a clean return to old assumptions without friction. Watching silver right now feels less like watching a price chart and more like watching a pressure gauge. The needle isn't redlining, it's just not where it used to be. And anyone who watches gauges knows the most important movements are often the smallest ones, especially when they persist. So the real signal won't be a headline screaming collapse or breakout. It will be whether these structural adjustments reverse or entrench. Whether margins relax or tighten further, whether delivery timelines normalize or remain stretched, whether premiums converge or stay stubborn, those answers aren't here yet. And that's the point. We're watching the setup, not the resolution. And in markets like silver, the setup is often where the story really begins, long before anyone agrees on what it means.